Hello folks. So we are gonna look at the chart today and we're gonna try to figure out how to trade when we don't have a bias. Because this is very important, as sometimes we don't have a daily bias, and in those kind of scenarios we need to learn to like how to trade in this kind of problems. So, and also one more thing, so all these videos I'm making as of now, these videos are made for myself, and these are more of like a private journal which I will look at later to like know how I used to trade and how I develop myself. So that's the main purpose of this channel as of now. But in this video I will demonstrate how the price action is absolutely algorithmic, and how the market makers manipulate the price in such a way that it's exactly like 100% accurate, and it's 100% based on algorithms. Okay, there is nothing like buying pressure or selling pressure. The whole market is based upon algorithms. All right, so we can see that if we go to the daily chart, we can see that right now the price is in this way, and it took this equal highs there. There is no PD arrays to really fall. You can see the market came down to this daily fair value gap and went up, and then it's just consolidating in this zone. All right, so the first thing we're gonna do is so we have no daily bias. All right, so we're gonna just mark the previous day high and previous day low. That's the first thing. Now we're gonna drop into a 1 hour chart, and for today in this video I will show you the London session, and if I have time I will show the New York session, how I took the trade, and if I don't have time I'll just make another video about it. But today I will be looking at the London session, which is from 2 a.m. as you can see, London open 2 a.m. till 5 a.m. So let's assume that this whole part is not there, so we just know all this part as of now. First thing we're gonna do is we're gonna mark the daily open, which is at 00 right there, the opening price of daily, and it's very important. The next thing, we can see that there is an order block. Oh wait, before that there is a fair value gap here, which is a BC, a buy side imbalance and a sell side inefficiency, and dropping into this fair value gap is this order block. It's a bullish order block, and the opening price of this order block is the change in state of delivery. So we're gonna mark this as 1 hour or as our 1 hour order block. We can see here. So that's our markings in our 1 hour time frame. So the next thing we're gonna do is drop into 15 minutes time frame, and let's just assume that this whole thing does not happen. It's only till here, till like 2 a.m. in this spot. So as usual, we're gonna mark the PD arrays. For example, there is a fair value gap here. It's also a BC. There we go. An order block here, which is dropping into the 1 hour higher time frame order block. So we're gonna put the opening price of this 15 minutes order block here, and I'll tell you how these prices are respecting all these PD arrays later. As of now, we're just focusing on marking the PD arrays before this 2 a.m. time frame. We have our daily open, we have our 15 minutes order blocks, we have our fair value gaps, and that's our 1 hour fair value gap. Also, we can see that there's a previous day high, which is there, and our previous day low sits right there. That's our previous day low, that's our previous day high. So we're gonna now dig into the chart, and we're gonna go to directly 1 minute. All right, so London opening time is 2 a.m. and don't worry, this might look like a mess to you for now, but don't worry, I'll explain each and every part slowly, so have patience. Okay, so let's just assume that this whole thing did not happen and we are right over here in this part. So we can see that The London Open is on 2 a.m. So I've marked this here, a vertical line. And all these green rectangles, these are 15 minutes fair value gaps. Here also there is a 15 minutes fair value gap. And this blue line is a 1 hour order block that I've marked before. So as we move into the London chart, we need to mark the liquidity levels. You can see there is an equal high here, also a lower high, lower high. So basically these all highs makes it a low resistance liquidity run. What that means is that price gonna shoot up, like it's gonna destroy this level and it's gonna like immediately destroy these other two levels. So this is basically a low resistance liquidity run. A high resistance liquidity run will be where there is a high and there is a higher high, but in this case it's a high and a lower high, which makes this a low resistance liquidity run. All right, so that's our primary buy side liquidity here. That's the limit where we're gonna like trade into. That's like the final destination there. And before the London starts, we can see that there is also this high here. All right, and we're gonna mark this as our buy side liquidity. So let's just assume that this whole thing did not happen. This nothing happened here. So as of now, we're in this situation, and the London opens, and we can see that it's going down. And while going down, it made a CB, a bearish fair value gap. We're gonna mark it, and we're gonna like extend it. So what we are really expecting here? So we can see that the price is really close to this blue line, which is the 1 hour order block. And also there is a sell side liquidity over the right there. Yeah, there is a sell side liquidity there. Also we can see that there is this one, which is a minor sell side liquidity. All right, so what do we have till now? Let me just change this to up. All right, so the price came down, the London starts, it came down, and while coming down it made a fair value gap here, and then it entered the 15 minutes fair value gap. As you can see, this green color, that's our 15 minutes fair value gap. So we will not be looking for trading right now. Our main thing is we need to capture reversals, because London is famous for reversal. Okay, London is famous for doing the manipulation part. All right, so what we want is the price to go to an important level and to make a liquidity sweep or a turtle soup or any kind of those stuff, so that it reverses to the other side of the liquidity. What I'm trying to say is that I want the price to go down, so destroy this minor sell side liquidity and to destroy this main sell side liquidity. I want it to sweep the final sell side liquidity, making it a turtle soup, and then waiting for a market shift structure. All right, so we can see how the consequent enrichment of this 15 minutes fair value gap is holding the price. Then slowly it came down again. We can see that there is a small fair value gap here. Look how it's beautifully holding that. And if you put this 50, it's 50%. Look how the fair value gap, its consequent enrichment, is holding this. This is purely algorithmic, guys, and like trust me, this is like how the market works. Okay, there is nothing like buying pressure. Okay, there is nothing like, you know, it's everything algorithmic. Okay, all right, so we're gonna delete this for now. All right, so the price went down. We're still looking for reversals. Okay, we're still looking for reversals. It then went to this 15 minutes fair value gap. Oh, by the way, this made this action, it made this fair value gap inverse fair value gap. We can write we wrote here inverse fair value gap 15 minutes. All right, so next it went down to this level, which is a 15 minutes order block. All right, Okay, I'll just quickly go and show you that order block. Do you remember this order block here? The opening price of it? That's our 15 minutes order block. All right, so we went down to that order block, and now we can expect some kind of reversals. Okay, when we entered this line right there, we can expect some kind of reversals. And we can see how this order block line is like it's holding the price here, and in drop down, went up above, tapped it and came down again. Now finally it went through this sell side liquidity, and also we can see that now the price is within the range of this 1 hour order block, which is our primary drawn liquidity was, because like we wanted the price to come down, make a sweep of liquidity, and then it reverses. So please note that now our price is within this range of order block. And what we can say is that also make sure that also make note that we are in a one minute time frame. So all these actions are happening real fast. Okay. All right. So the price came down, and here we are expecting a reversal. We are expecting a very, very good reversal. It came down, and then you can see it just swept this liquidity level, which is the sell side liquidity. It swept it, it made a turtle soup, and look how this order block is handling the price. And it went up with displacement. Displacement is basically a fair value gap. It went up with displacement, and the second time it displaces. This made a market shift structure, as you can see here. So the key rule of the 2022 ICT mentorship model was that a liquidity sweep to an important level, market structure shift, the first fair value gap, we're gonna buy here, exactly right there. All right. So also we can see that there is this order block, and if we extend this opening price, you can see how beautifully the price is respecting that order block. Look, just look at here. Look how beautifully the price is respecting this. This is what I'm telling you, like this is all algorithmic, and the market maker, they know what they're doing. Okay, so and market structure shift, and look how beautifully this order block is handling it. Also, if you put this consequent enrichment of this fair value gap, you can see how it's handling the price. Look here. This is a very, very beautiful scenario here. All right. Also, if you want to use the OTE, you can absolutely use the OTE. There is no problems in that. So from the low point, if you go to the high, it has to be within, it has to be touching the 0.6. Oh my God, look at this. Look how beautifully this is working. So ICT told us that OTE is basically the range below the equilibrium, and preferably the 0.62, 0.705 and 0.79. And look how beautifully it's touching the 0.62 right there. Okay, just right there. So we have multiple confluences on this. And also there is a breaker block here. You can see there is a good breaker block here. If you guys don't know what's a breaker block, let me explain. So there is a short-term low here. You can see there's a swing low. This is called this short-term low, and this is being rated here. So it's basically low, high, a lower low, and a higher high, which means that this part has a bullish breaker block, and the bullish breaker block is being overlapped with a fair value gap, which makes this a unicorn setup. And ICT told that algorithmically unicorn setup is the most strongest setup in the trading models. So we can see how it's how the fair value gaps is holding the price, the order block, look how it's maintaining the market structure shift, the OTE, and the breaker block. So everything, yeah, everything is saying you that buy, you need to buy here right now. Okay, everything is saying you that. So we're gonna put our buy in the high of this fair value gap, and we can put our stop loss right below this low. Okay, so you can see that this 3 candles make the fair value gap, so we're gonna put like right there. ICT told us to put this stop loss below this the candle which made the fair value gap, and also he told to like put 1 pip below, so 1.2 or 2.2 right there. It's just below the consequent enrichment of this fair value gap, and we're gonna mark, of course, our drawn liquidity, which is our buy side liquidity, and we can see how it goes there. Okay, so that's the first trade we took, but I'm gonna explain you a little bit more. So yeah, so we got our first entry there, and look how beautifully it is respecting this 15 minutes fair value gap. Look how beautifully it's respecting this fair value gap. Okay, so it went up, touched this consequent enrichment, came down, went up, came down, and then it made some fair value gaps in here, also there. Then finally, you can see it's not closing above the buy side liquidity. Look, that's the buy side liquidity. It's not closing above. It's only showing off this wicks. Okay, wicks does the damage, and I actually told this line. So wicks does the damage, and the body shows where the price is going. So it's just doing the damage. Okay, what this is telling that it needs more liquidity to push himself more up. Okay, it needs more liquidity so that it can go up. Basically, the price wants to go to a fair value which is below the equilibrium because it wants to go up. That's the thing. And to measure till where this might go to get the fair value, we will use the premium discount tool. So from this low, that high. So we want ideally our price to go below this premium level. We want it to go to discount, and then we want it to like shoot up. All right, so we can see that the price is not close above it, it came down. All right, oh, by the way, our first trade is over here. Okay, our first trade, we got successful right there. All right, so now it's going down. It created this fair value gap, but we're not gonna mark this because like we can see this BC here, the buy side imbalance, sell side inefficiency. This basically became an inverse fair value gap of like 1 minute, and you can see how the price is beautifully respecting the consequent enrichment, which is the 50% of the fair value gap. And if you don't believe me, trust me, this okay, look. So we're gonna make one more fair value gap here, the CB, which is basically a bearish fair value gap. Let's put a different color to this. All right, I'm making a dash. Look how it's overlapping. Look how beautifully accurate this is. And do you still think if it's random? No, it's not. Okay, it's definitely not random. So yeah, it touched there, came down. So the thing is that when our market when the price was going up, we saw 2 fair value gaps right here, right? It's the first one, the second one. We're expecting the first fair value gap to be a breakaway gap. Okay, yes, I just dropped like a very important line here, a very important line, and please remember this, that when it reverses, we ideally want this first fair value gap like just below the low, the lowest low in our bullish scenario. We want the first fair value gap to be ideally breakaway gap or just like a measuring gap. As you can see, this is a measuring gap. Okay, it did not completely filled it up. It just went to the consequent enroachment and it just shoot up. So this is a measuring gap, and this is a breakaway gap because the price did not tap it at all. So the price needs to come down to tap it and then shoot up. If you can put the Fibonacci here, we can see the OTE levels right there. We can see how the 0.62 is right there, which is the consequent enroachment of this second fair value gap. Also the main 0.705 is right here, which is inside this first fair value gap. All right. So as the price came down, okay, as the price came down to this fair value gap again to balance it, because fair value gaps is basically an imbalance and the price always balances it. Okay, so the price needs to balance this fair value gap, so it came down. Okay, it struggled to come down a bit, but eventually it did come down, and we can see that here when this candle closed below this fair value gap, this is completely balanced. Okay, this fair value gap is completely balanced, and now we can go up to our next liquidity. Also, we can see that while making this fair value gap balance, the price came down to this important level, which is a 15 minutes fair value gap. Also, it touched the consequent enroachment of this 1 minute fair value gap. As you can see here, the dotted line is the consequent enroachment, and this green is the 15 minutes fair value gap. Look how it went down, tapped on these two so that it can get a fair value price, and this range in the OTE is also a beautiful 0.705 number, which is basically saying you that like buy, you need to buy now. Also, we can see how the price went below this 15 minutes order block. Okay, so I would have bought as soon as we hit this. Okay, as soon as we hit the first fair value gap again, I would have bought here, because I know that it's gonna go up anyways, and our stop loss, it should be safe. So we're gonna put this just below this candle which made this our first the first fair value gap. We're gonna put like just there, just a bit below the candle which made the fair value gap. And of course we're gonna like aim the next here. We're gonna aim to there, actually there, to this equal highs, and we got this trade. That was our second trade. Actually, we can see 3 trades in London itself. Okay, we're still in London, and we already saw 2 trades as of now. The first trade was in the second fair value gap here, after the market shift structure and the order block, also the breaker block, making it a unicorn model. That was our first trade. Our second trade was the retracement when it came back to get a fair value price to go up. So it went down to this level, to below the 15 minutes order block, touching this fair value gap, making it a balanced price range, also tapping the 0.705 in the Fibonacci, the OTE level, also being in a very good discount price between the fair value gap of 15 minutes and the consequent enroachment of 1 minute fair value gap. And then we can see the displacement here. So imagine if we took a buy there, we would have been in a bit of drawdown, but it's okay, because we knew that it's not gonna come below this fair value gap, and eventually it's gonna reach to our main drawn liquidity there. So yeah, so the price went up, created fair value gaps, and as I told you, after a consolidation, the first fair value gap, ideally it needs to be a breakaway. As you can see, this is a breakaway. The second fair value gap, this is a measuring gap. As you can see, this candle came down a bit here and then went up. The same thing I told you right there. Ideally, our first fair value gap should be a breakaway. Nothing should be in here. The second one can be a measuring, where the price comes down and go up. You see, it's just repeating every single time the same thing. It's absolutely 100% algorithmic. Okay, There's no doubts in that. And I'll show you one more example. So we can see that the price went over this primary buy side liquidity, which was our equal highs there. Oh, it was the low resistance liquidity run. And you can see, what did I tell you in the starting of the video? I told you that the price is going to shoot up when it destroys these levels, right? Wait, let me just mark it again. These levels, when it destroys this, it's going to shoot up immediately. Look what it did. Boom, boom, boom. And then just shoot up there. Okay, now you might be asking, okay, like we don't know what's gonna happen next, right? So you might be asking, like, okay, so we took our liquidity level, which is the external. As I told you before, the buy side and sell side liquidities are external liquidities, and the fair value gaps, order blocks, all these are internal liquidities. So I think you should know that after taking the external liquidity, the price will go and seek the internal liquidity in a discount if the price is bullish. All right, please note that if our narrative is bullish, we want to buy in discount and sell in premium. Okay, so after taking this liquidity over here, what's gonna be what's the price gonna do? The price is gonna come down to a discount zone where it balances, where it attains a fair value price in a fair value gap or an order block, so that it can further go above if it's a bullish move right there. So I wrote a beautiful presentation of premium and discount. Look, that's what I'm going to say now. So we can see that it went up, right? And it went above this primary buy side liquidity. So after taking liquidity, it's going to come down to fair value gap. To get a fair value price and to go up. We can see there is a fair value gap here. All right, let's mark this up like that. This black line. Now this fair value gap failed. Do you know why? All right, so the first thing I told, like just now, I told that the price needs to be in discount. After taking the liquidity, the price needs to come to discount so that it can get a fair value. Because the market makers, the institutions, the banks, they buy at discount. Okay, I mean, it's not simply like that, but you can simplify it. So that's why this broke. I'll show you the premium discount, how to make it. So we don't know all this happening. Okay, so we just know that there is a high till here, so we're gonna mark out the high. Oops, my bad. There we go. We're gonna mark the high, and we're gonna mark a short-term low. So our short-term low will be that one. That's the short-term low. Look here. Boom. A low and a high. So we will put our premium discount tool here, which is basically, it divides like into 50-50 from the low to high. That's low, that's high. Look, what is the first PDR what is the first fair value gap below the discount? Okay, first of all, we are in a bullish narrative, so we're gonna buy at discount. So anything below this 0.5, which is the equilibrium, any PDR below this is a discount PDR. The first PDR below this equilibrium is this fair value gap. You can see it's overlapping on this equilibrium, this fair value gap, right? And that's our first fair value gap, which is below the equilibrium, and the price is gonna tap the first fair value, the first fair value it can, and then it's gonna go to the next liquidity to hunt more liquidities. So we can that's why I wrote a beautiful presentation of premium and discount, because you can make another buy here because there is another fair value gap there. So this means that after taking a liquidity, it's gonna come down to a discount, and the first fair value gap in the discount we're gonna buy here. That's what I meant. We're gonna buy here. We're gonna put our stop loss right there, and we can aim for 2 RRs, which is a fixed one. Okay, we can aim for 2 RR, which is, or we can just aim this high. Okay, we can aim this high because the price is gonna be going going over this high anyways. So yeah, we can aim this high, and we got a beautiful 2.4 hours there. That's our third trade in London itself. And after that, it just went up, eventually till the previous day high. Okay. And that's all New York. I'll explain you in a separate video, or maybe after some time, if you can see if the video is long, then it's of course that I'm going to explain you the New York later. Okay. But if you see the video is about to end, it means that I have no time basically. So I'll explain the New York reversal later. But let's get again like a review again. So a small summary. Okay, that's a good word. So before 2 a.m. we're gonna mark the important liquidity levels, which is the buy side liquidity here, and we got the equal highs. It's a low resistance liquidity level. That's our primary buy side level. We want the price to crush these liquidity. All right. So 2 a.m. starts. We can see the price is rallying down to our important levels where we can expect a reversal. That is what we want. We want reversals in London. We want to capture the big movements, right? So we want the price to go to an important level. For example, here we have the sell side liquidity. We also have the order block of 1 hour, which is a very higher time frame compared to 1 minute. And once it's sweeping the sell side liquidity, once it's gets within the 1 hour block and 1 hour order block and sweeping the liquidity, we want to see a market shift structure and the first fair value gap. After that, we're going to trade there, and we can see a multiple confluences here. Order block is respecting. There's a bullish bullish breaker block with a fair value gap. It's a unicorn model. All this stuff are like conferences are here. We're gonna mark, and we're gonna like take an entry there. We're gonna aim for this buy side liquidity. So once this is done, we want to see like what happens next. So the price not close above this. It came down. It wants to be in a discount zone again to go up, right? So we put our Fibonacci again from there to there. We marked our 0.62 and 0.705 levels. Then I told you how the fair value gaps needs to be balanced out. So as soon as it tapped here, we got to buy here, and we see that how it got balanced at this spot right here. Also please like see how the consequent enrichment of the fair value gaps is being respected by the price. It's being like beautifully respected. All right, so we can see that here when it balanced this second fair value gap, we can see the price went below the 15 minutes order block, tapping the 15-minute fair value gap, also tapping the consequent enrichment of the fair value gap of 1 minute. So the price was like in a perfect range of buy. And if you did not buy here, then the next thing you want to buy, the next part where you want to buy is right over here. Because when after the price is in the fair value location, we want to see the price close above this order block. As soon as it's closing above, we can buy here, and you can see the change of just change instead of delivery right there. Look, the price came down and up. That's the change instead of delivery. We could have got another buy here, and ideally we want this to be breakaway gap. It's a breakaway gap. This we want it to be a measuring gap, so it came down a bit and then went up. It went to this buy side liquidity. Finally, it went to the primary buy side liquidity. After going that, it wants to come down to a discount to go more up. So it came to the discount, the first fair value gap in the discount. We took another buy here, and we can see how beautifully it goes up. It rallies up to the previous day high. Okay, that's our previous day high, and look how beautifully it goes up there. So that was pretty much how London session was working today. And also, just a quick bonus, I told you the fair value gaps needs to be balanced. So for example, this is a measuring gap because it's like half filled, right? So if you just scroll here, we can see that it's filled up there. Look, it's filled up there. And like later on also how the price is respecting the consequent enrichment. Okay, look there also. It is absolutely algorithmic. This is pure knowledge I'm giving you right now. And you might not understand the video once, so like you can watch this again and again and again until you understand, because this is how you determine, or like the narrative, how you trade in a lower time frame without having any kind of bias. This is the clear gem you have. Okay, so yeah, that's it for the London session right now. And also make sure to take notes of everything and take pictures if you want. All right, then, see ya. All right, hello folks. So we're in the New York session now. I'm just gonna make a quick video about this. And we saw previously how the London session was acting upon the lower time frame and how we traded without a bias. And now we're gonna quickly go over this New York session and end the video. So we're still in 1 minute. Okay, we don't want to be in like a higher time frame. Lower time frame, it's also like it's pretty good. So it went up to this previous day high. As you can see, it rallied up to previous day high, and we're expecting a reversal here, but this is still 5 a.m. The New York session starts from 7 a.m. so we're expecting like a reversal here, because it tapped an important level, previous day high. What are the, like, you might be questioning, like, what are the important levels? Okay, previous day high, previous day low, previous week's high, previous week's low, and each of the sessions high and low. These are your important levels. Other important levels are like equal highs, buy side liquidity, sell side liquidity, and like you need to notice how some liquidities are low resistance, some are high resistance. These are all external liquidity. We are talking about external liquidity from where it's going to be reversing. All right, here previous day high, rallied up and came down with displacement, a lot of displacement. Okay, so the first thing we see, we want to see in a reversal is a market shift structure. Okay, a market shift structure. So that's our low, and that's our market shift in structure, which also have this beautiful fair value gap here, but we'll get there in a minute. Let me just, is it red? No. Okay, wait, let me just copy this, paste it there. Gonna pull this up right there. Gonna pull this up here. Yeah, I'm a bit lazy, it's fine. All right, so what's the first thing I told you? I want to see, ideally I want to see the first fair value gap after market, the first fair value gap to be breakaway gap, and we can see that there is a little bit of damage here. Okay, we're not happy about this. There's a little bit of damage, but we're fine. I think it's not even filling the first quadrant. I don't think it's filling the first quadrant too. It's not even filling the first quadrant, so we're absolutely fine with that. And the second fair value gap here, we see how there is an order block also. This, my friends, are this one. This is a bearish order block. Please note, this is a bearish order block. Okay, bearish means like all the candles which are going up, you know. I think you guys should know the basics of order blocks and fair value gaps. So yeah, I'll not explain these basics, but this is a bearish order block, and the opening price is the most sensitive area, and also this wick here. These wicks and the opening prices are very, very sensitive areas. So like if you put like a quadrant here, we can see that how it's in between the first quadrant and the second quadrant. It's not closing above that, right? So it's very, very sensitive area, and when we don't want the price to close above that. All right, so yeah, so we see that there is an order block here, also a fair value gap, and my eyes are right now in to look for a breakup block, and I just spotted the breakup block here. There's the breakup block, because equal highs, right? High, and this got rated there, So it went up, high, low, higher high, and a lower low, which makes it a breakup block. That's our bearish breakup block, which is indulged with 2 fair value gaps. And we're gonna take the fair value gap, which has a cute little order block, and this makes our perfect entry for bearish. We're gonna put our stop loss right there. And what can we aim? That's our question, right? So for to answer that, the first partials you can take it right right over here. I'm just gonna go to 15 minutes. Right, before the New York starts, you can just mark the PD areas here. So this is a fair value gap here, and now let me just go to 1 minute. So you can aim for, sorry, I had to sneeze there. You can aim for this fair value gap. I had to sneeze a lot. Okay, but the thing is that you could have done all these, and but you should know that we're trading in New York time, right? So this part is all London, and from 7 a.m. we can see there's a New York time. All right. Now we can see that before the New York even starts, we can see that there is a reversal already. Yeah, I just explained the whole thing here. This fair value gap and that one. I know how the market shift structure, the order blocks and all. If you want, you can take an entry there, and you can just exit at the high of this fair value gap. Yeah, we're just entering at PD arrays, and we're gonna mark the bearish PD. We're gonna mark the opposing PD arrays as our targets. Okay, and we also have this order block here. It's a bullish order block, but what we are expecting is that we are expecting a reversal, because it tapped the previous day high, and we want a reversal down back to the previous day low. And our plan is not to get the whole trade. You can see it's still going down there, but it's going to eventually top there. But our plan is not to get the whole trade. We just want a good, solid, guaranteed trade. All right, so what can we see here? We can see that the price went down to this fair value gap. It got its liquidity done. Yeah, it also went to the order block. No, a very strange thing here, or a very interesting thing, that the price did not close below these 5 minutes order block, which I'll just show you the 5 minutes order block here. In case you're wondering, that's our opening price of the 5 minutes order block right there. And we can see how the price did not close below this, which means that the price wants to go up to a premium so that we can sell. All right, we're expecting a reversal to the bearish. So when it's bearish, we want the price to go to premium. If you know the basics of ICT, that's what I'm talking about. We want it to go, let me just mark here. This is discount, that is premium. We want it to go to premium so that we can sell. Yeah, we want to short. Now if I put this Fibonacci here, oops, it's not Fibonacci. Oh no, my bad. There we go. That's the OTE from high to low. So New York starts. We are expecting the price to go to 0.62, like basically this range, and we're expecting one more reversal. So I told you before also that fair value gaps needs to be balanced. We said the first fair value gap was balanced here, and this big breakaway gap was balanced here. As you can see, the price now closed above this, which means that now it's time for the New York session reversal. Yep, guys, this is the best reversal in New York. So that is the low here. This is the market shift structures. Wait. That's the market shift structure. And we also see that there is a order block here. If you want, you can just short it right there. Wait. just short it right there, put this there, and we can aim for this level, which is the fair value gap here, which did hold the price for some time. Or if you want, you can just put it in this sell side liquidity. You can take a bit of partials here, and then we can aim for this equal lows there. And let's say you did not like enter this trade here. You missed this part. Okay, you were not sure that it's gonna go down. You did not miss this part. You did miss this part. You did not know that it's gonna go down. So what's the next part we're gonna trade into? So we want to see the price go below this fair value gap, because fair value gaps are a key points of reversal. But if we go below this, then we are sure that like there's gonna be no reversals at all. Okay, we can see there is a big bearish move here after consolidating a little bit time. So I think I've told you that I've told you many times, after a consolidation, the first fair value gap, we want to see it as a breakaway gap. You can see this gap, nothing is in between here. I'll just show you here. This fair value gap after consolidation, it should be a breaker block. Sorry, a breakaway gap. Nothing should be in there. So yeah, so it went down till where? Till the consequent enrichment of this fair value gap. Look how accurate is that to the consequent enrichment of that fair value gap. And then retraces above to where? You now you should be answering to where it's gonna retracing. All right, think about it, till where it's gonna retrace. Obviously it's gonna go till the premium. Okay, it's gonna go till the premium. That's the high, that's the low. The premium is here. And if you want an accurate answer, go open your Fibonacci and open the OTE levels. Till where it's gonna go? It's gonna go till 0.62 and 0.79. It's gonna go between these levels. What do we see in these levels? We see this bearish order block. We're gonna put this opening price, okay, and we're gonna measure this body, not the wicks, the body. We're gonna divide the body into 4 parts, quadrants there, and we don't want to see the price closing above the 0.5, the mean threshold. We don't want that. The price is not closing above this. The price is just closing below the first quadrant, which is absolutely fine, and this is a pure good selling option. So we can share, we can sell from this order block. We can put a stop loss here below, or like the stop loss above this order block's wick high, and we're gonna aim for simply right there. There's a beautiful, look at that, risk to reward ratio is 6. That is a beautiful trade right there. So that's what I'm trying to say. If you could not enter here in the target here, if you could not enter in this expansion, you know that after expansion there will be a consolidation. This is the first consolidation. This is basically a market maker sell model. Okay, consolidation, then second redistribution. After second redistribution, there is one more second consolidation part. You can see after consolidating the first fair value gap, the first bearish fair value gap, it's a breakaway gap, nothing is in between here. Second one is a measuring gap. This is all like perfectly algorithmically designed. A perfect entry there. Boom. If you want, you can aim to even lows. For example, these equal lows there, which is gonna be there, or like the main sell side agreement there. So that's how you trade without a bias, using only lower time frames, 1 hour, 15 minutes, 1 minute, and nothing else. So yeah, it's pretty like logical when you think about it. And yeah, I wish you very good luck, and I hope you understood a bit of the lecture. If you do not listen, if you do not understand, just watch it again. Okay, just watch it again, make notes of it, and yeah, the key points are reversal, expansion, consolidation, redistribution, consolidation, redistribution till your main liquidity. All right, so that's it for today, and today was the last day of September. We're gonna start the next month with a very strong mindset, and we're gonna trade, and we're gonna earn a lot of money. So yeah, thank you and peace out.